following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today again. We're broadcasting on 94.1 FM WNBU as well as cable TV 10 in New Bern. We also are streaming over the internet from our website, www.dlblain.com. We welcome comments and questions from our viewers and listeners. Most of the ideas for our show come from topics that you request or questions that you ask. So give out our phone number, which is 252-633-0107. You can also contact us by email at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. Visit us on the website, www.dlblain.com. There you'll find archived copies of the shows as well as information about myself and my firm. So today I thought we would go over a little bit about our view of the investment world, where we stand today. It's been quite a wild ride in the markets. The stock market particularly peaked back on April the 29th. Since that time, we had, through the summer, the markets kind of gradually drifted downward, culminating in an August crashing, basically, of the market, what we call a waterfall decline, where markets went down significantly. This, if you rewind the clock, if you remember, Congress in the United States was debating about the debt ceiling, and they announced that they had come to an agreement, but yet the next week we saw significant downturns in the stock market. Those downturns continued through the month of August and September, culminating with the low on October the 3rd. Since October the 3rd, equity markets have basically gone straight back up. What we're seeing is this, what I call risk on, risk off. Well, not just what I call, other people call it that too, but a risk on, risk off trade, meaning that anything risky assets is all getting sold at the same time, and everything risky is getting bought at the same time. So it's either risky assets are favored or safe assets such as U.S. Treasury bonds are favored, and there's really no distinction between the different types of risky assets. It's just risk on, risk off. It's like a light switch. And so as we sit here in December, I thought it would be useful to step back, take a look longer term, which is what we try to do. Essentially, as of yesterday, the U.S. stock market was slightly positive on the year, believe it or not. Since its peak in April, no, it's certainly come down since then, but for the year of 2011, it's a little bit positive. So as investors, you need to make sure that we're stepping back from the day-to-day gyrations of the marketplace, taking a longer-term view. Now, it doesn't mean sticking your head in the sand, and we'll talk about that a little bit later in the show, but it means that you have a good understanding of what's going on, and you don't get too wrapped up in the day-to-day, week-to-week, month-to-month variations of the various markets, stocks, bonds, commodities. So today, as we sit here, we think that this rally will continue to bear fruit through the end of the year, possibly into next year. So at a minimum, we would recommend, whatever your asset allocation policy is, that you at least have that amount of risky assets. You may want to bump it up slightly. Coming off of an absolute dismal quarter such as we had in the third quarter, the percentages would indicate, and history would indicate, that the fourth quarter will be much better. This time of year is typically good for the market. There are a lot of things, a lot of positive things amongst the negative that's in the world that indicate that it's worthwhile at least having a market allocation to the stock market. If you don't have a strategic allocation, you should probably have one, some general idea of how much risk you're willing to take. But once you have that, so today we would be encouraging people to at least take that much. If they're comfortable, maybe a little bit more, maybe overweighting risky assets just a little bit here for a couple of months. Within the stock market, though, we operate in a global world. And so we like to differentiate between different regions of the world and where we think people's money would be best served today. It just so happens that the U.S. has been our favorite sector of the world for several months now, since the beginning of this year. Despite the problems we have here in the United States, it still remains one of the top economies. Well, it is the top economy in the world, but in terms of its fundamentals, its growth rate certainly is not to the extent of some of the newer, like China, but the fundamentals of the economy, you still have the world's largest economy by GDP, you still have very creative people, you have very innovative people. And so capital has been coming to the U.S. in this global recession. And so we've been emphasizing the U.S. investment. So if normally you allocate 50% of your money to the U.S. and 50% overseas, we would say overweight the U.S. now, maybe 60-40 or something along those lines. Also, after just an awful year to 18 months, we would also recommend taking a look at emerging markets again and getting some money put to work in emerging markets. The 4 big emerging markets are China, Brazil, India, and Russia, the so-called BRIC countries. BRIC meaning Brazil, Russia, India, China. These are some of the faster growing economies in the world. They've really taken a breather the past year, especially the stock markets have really lost a fair amount of money. The U.S. market has done much better than the emerging markets, and we think that it's creating a somewhat attractive entry point where if you've been away from emerging markets or you've been underweighting emerging markets, as we have, that it may be time to take a look at them again, that these countries are not going to go out of business. We think their emergence from sort of third world countries will continue to take place, and we think it's prudent to take a look at it. We're currently underweighting Europe outside of the United Kingdom. There's a lot of problems still, as the headlines every day in the news indicate, with Greece and Italy and the Eurozone and Germany and France, bailouts, you name it, Europe has been in the news a lot. And so we don't want to completely avoid it, but we're not sure that it's time to go in with both feet and be buying a lot in Europe. It's just a lot of risk factors involved there. Still not quite sure how it's all going to shake out. The same thing with Japan. Japan has still been mired in difficult times after the tsunami. Also was just another blow, and so we're currently underweighting Japan as well. Well, we're coming up on a break here. When we come back, we'll continue to talk about which equity markets we like, which ones we don't, as well as talk about the bond market and commodities. So for All Things Money, I'm your host, David Blain. We'll be right back.